This is The Future of Money, a podcast where we hope to educate and get educated about the new world of blockchain and digital money. And my name is Eric Den Boer, and I will be your host. Hi, and welcome back to Blockchain, The Future of Money. This time we do have a lot to talk about. There's some very important things happening today. Ethereum has its big merge today, September 15th. Remember that date. And next week on September 22nd, we have Cardano's Vasil hard fork. And we will touch on these things today. But the main reason we're here, we're talking about DeFi. So, decentralized finance. And with me today, again, we got Lee and we got Jacob. Real quick, just tell us who you are. Jacob.
Hi, Jacob Oliver, U.S. editor at Crypto Briefing. Second time here, glad to be back. Thanks for having me.
And I'm Lee Wood. I'm KUAF's general manager.
Awesome. So let's start with DeFi. What do we want to say about DeFi?
Well, so DeFi, decentralized finance. Have you ever talked about it on the show before?
We mentioned a little bit and touched it, but we haven't really got in depth.
I'll start from the beginning. So, decentralized finance is essentially, to give you the broadest explanation, the idea is that you can use computer code to execute financial contracts without a human intermediary. So the way this works is, you mentioned Ethereum's merge. We're going to talk a bit about what that means today. Yeah. I'll kind of start by talking about Ethereum is what is known as a Turing-complete blockchain. Yep. What that means is that it can run smart contracts. Something like Bitcoin, all it does is store value. It doesn't really do much beyond keep a list of transactions and everyone's account balances. Something like Ethereum, though, you can build applications on. Yes. So the very first thing that people started building application-wise on blockchains was financial products. If you go back to the early days of the Bitcoin white paper by Satoshi Nakamoto, it's written in such a way that is very much has financial collapses in mind. And it's the problem it was trying to solve was how do we create a solid monetary system that is sort of impervious to these sort of macro conditions, or at least that's one of the ideas.
Actually, a little footnote there.
Yeah.
In the first block ever minted on the Bitcoin blockchain, it actually states about the 2008 bank crash.
Yes.
And it gives the date and the newspaper and all that kind of stuff. So yeah, you guys can look it up.
Yeah, I mean, it's thought that the invention of Bitcoin is in direct response to the 2008 crisis, although it seemed to come along pretty quickly after that. So the idea that nobody was working on it before that is kind of...
Yeah.
Well, there were people working on digital money before that, but there was no solution to the double spending.
Right.
You know, we can talk about that. Double spending could be another episode.
I mean, double spending is exactly what it sounds like. You know, a bank makes sure that you don't spend the money twice by keeping track of the money in the account. That's simple enough. But blockchains can do this as well in their current state. So now back to DeFi. So when you can build applications on, or what's called smart contracts on a blockchain, a smart contract is a piece of code that executes itself when certain conditions are met. Mm-hmm. So it makes them pretty ideal for things like, for different financial contracts. Everyone, at least in the early days, and really still, are thinking about cryptocurrency as how do I use this tool to make money? Mm-hmm. The original idea was, well, it's a volatile asset. It seems to appreciate over time. I can buy it and hold it. Well, okay, but now that we can build smart contracts, and this sort of started taking off around 2017, you started seeing these decentralized lending protocols where you can borrow Bitcoin or borrow more appropriately, borrow Ethereum or something like one of the many tokens that exist on the Ethereum blockchain. You can, from there, start doing all kinds of complex financial procedures. You can, trade on arbitrage. You borrow here and sell there for a profit. You can, anything you can think of with a traditional banking system or brokerage or whatever, you can short different tokens. You can buy options or perpetual contracts or all of these things. Mm-hmm. And the blockchain executes all of this according to its code. Now, that sounds pretty cool. But as you probably talked about before, like one of the drawbacks of a blockchain is that it is more or less irreversible.
Yes.
Which means if you make a mistake doing one of these complex financial maneuvers, it's pretty much done. There's no broker to call and say, "Oh, I didn't mean to."
Yeah, there's no system in place to undo.
We've discussed that before because the blockchain is very final. You do this transaction and that's done, and that's
Yes.
why it's so important that whenever you do something, that make sure that you triple check it before you actually go ahead and do it. I just want to say the DeFi. So from what I have learned is that you will have three main things with the DeFi that is built on. First of all, is cryptography, which makes it secure, and then also built on the blockchain technology, which we were talking about. We put everything in transactions into a KBIS or to a block, right? And then we have, and this came with Ethereum, was the smart contracts. And I do know that Cardano also has smart contracts today, but I do think that the smart contract actually is. If we would have had smart contracts on Bitcoin from the beginning, that would have changed a lot, I think. But Ethereum was the one that started it, and then that's where we are right now. And so the smart contracts, I would say, is one of the main factors to why we can do DeFis.
Oh, of course. Yeah, it's the key mechanism without which you can't build applications on blockchain.
Yeah.
And so to say if Bitcoin had done this in the beginning, it's the shoulders of giants kind of thing. Vitalik Buterin, the primary inventor of Ethereum, I think it was 2013 or 2014 that the paper was published.
Yeah.
And by 2015 it was up and running,
Yes.
I think.
Yeah.
I should double check that. But anyway, he was reading the Bitcoin white paper. He was building on what went before.
Yeah.
And then it's kind of amazing that the second iteration of major blockchains, and there were some others in there that kind of failed and we never saw again.
Yeah.
Not worth mentioning, I guess. But Ethereum has stuck around.
And because of Ethereum, the way it was built so early is that there's so many others that attach themselves to it.
Right.
I mean, the ecosystem for Ethereum is huge.
Yes, and it's intended to be that way. It's intended to be as decentralized as possible, to be as accessible as possible to as many developers in the world. This is one of the reasons that it's last time I was here, we talked about the United States Treasury sanctioning Tornado Cash, which is a piece of code on Ethereum, and they actually clarified some of the rules this week, and so we'll get into that. You can get some of your money back out if you sign a form and fill out a bunch of information and stuff, but they're not going to make it easy, but they are going to make it possible. But anyway, by sanctioning this protocol, U.S. government effectively made it illegal to interact with this code, which presents problems. It's immutable. It's on the blockchain. It's there.
Right.
Yeah.
But for example, front-end providers stopped providing access to you. So if you have the know-how to get into the blockchain and write some code, then maybe you can interact with Tornado Cash. But
Okay, so
Yeah, sorry.
That's fine. But let's go back to how does this DeFi change everything when we're talking about banking?
it's a good question. The idea is, and this is all very ideological, I think. The idea is that if you can eliminate central power brokers from finance, that you can make finance more fair, more transparent, more equitable, and all of these things. There is a deep-rooted suspicion of central banks, of politicians, of monetary policy, of all the things that make money work on a global geopolitical scale.
Yeah, because it's on the blockchain. It's open for everybody, right?
That's right. Yeah.
And then also the other thing is that you don't need to trust a banker because it's a code running. So those things are really,
There's still an element of trust.
You bet there is.
I think I just wanted to throw that out there as a person who is. I don't. Interacting with a code is an odd idea for someone like me, and I think a lot of people like me. And so trusting and also knowing that there's like zero margin for error, like we talked about. You need to make sure that it's correct in what you're doing, and to not have a support system, even though that system is not necessarily there to support the customer or me. It's still there. Like you said, there's avenues you can go to try to rectify things or find out what happened. None of that's happening with the code.
No.
So I'm just making it clear that there's trust issues. I have trust issues with the code and banks.
Yeah, to talk about that,
I might just have trust issues.
Yeah, I was reading an article about this guy that by accident had sent a woman $10 million worth of, I can't remember if it was Ethereum or whatever.
I remember the story, but I don't remember which.
And then, he goes back and says, wait a second, you are not supposed to have this. Can you please send it back to me? Because obviously you can track it down and see where it's going and all that kind of stuff. And now this woman is like, well, you sent it to my wallet. I just figured it was for me, So now they're having, yes, you're absolutely right.
Yeah.
There has to be trust. But he has to trust that she's sending it back to him.
Yes.
But the thing here is that if he had triple checked everything and made sure that he got all the zeros and whatever in line, it would never happen. So in a sense there, if you trust the system, then you're doing the right thing. It's always the trust lays in the other end. And most of the times, the problem with trust is, unfortunately, it's human.
Yes.
And so the code is never wrong, so to speak.
Right.
But there are people that can go in and change code for their own intent, or you send something, or you do so.
Mistakes are made.
Exactly.
Mistakes will always be made.
Yeah, and
humans are doing it.
And the difference is that if you, like you said, if you go to the bank and you say, "Hey, I'm sorry, I shouldn't have sent her $10 million. Can we rectify that and fix that?" Right? And then the bank will go in and say, "Yes, you're absolutely right. She's not supposed to have that." But with a code, when you send it, you don't have that.
Sure.
So yeah, that is. That is a problem. So make sure that you get all your ducks in a row and everything, right?
Yeah, there is always trust involved. You hear the phrase "trustless money" or "a trustless system" being tossed around the crypto space a lot, and it's just absurd.
Right.
Sorry.
No.
But everyone is. When you put money on the table, you are trusting some counterparty, whether it's a piece of code or the developer who wrote the code, or you're expecting something to happen in a certain way.
Yes.
Yep.
And your example of the bank reverting a $10 million transaction, the bank never would have let you send that transaction in the first place. They would have asked, "Are you sure you want to do this?"
Yeah.
And you would have caught the mistake first.
Yes.
So you're right. There's really no support infrastructure in place, with the exception of things like Discord channels and people on Twitter.
Yeah.
And
I'm not saying that it won't exist. It's just that
Right.
not, the infrastructure is not built up enough.
Right. It will have to exist.
Right. Yeah. Okay.
But as time, they didn't build Rome in one day either. So
No.
I think as time goes, it's gonna get better and better and better. And banking system in the old days, if you go back to first kind of banking system was basically, it wasn't really banks. If you're going to go back to the early days, there were merchants that were out there and saying, "Yeah, you bought this from me. Here's a piece of paper that you owe me this," and so on, and you can then sell that piece of paper to her, and so on and so forth. And that's really how banking started. You can look it up. Anyway, one of the things is also though with the DeFi is the censor resistance. If you do these transactions, I can send you the money. Let's say that you are an underground group that is trying to. You have a very corrupt government and you're trying to replace the government, but you need money for that and all that kind of stuff. And I want to send you the money. Today, the government can go in and say, "Oh, no, you do that. I'm going to take all your money and everything you have, and we're going to put you on the blacklist." But if you are, you have your cryptocurrency and you want to sponsor that group, and it could be for something good or whatever it is, right? You don't have that censorship. So that's another thing that I think is good with DeFi.
Yeah, this one's tricky.
I know.
Because
it's a very, very tricky question.
Yeah, because we did talk about the idea of code as law last time.
Yes.
And just as a gentle reminder, I'm not a lawyer, but from where I'm sitting, code is not law.
Yeah.
Oh, yeah, and by the way, all of this is for entertainment. So.
Right. None of this is advice.
Do not take our advice.
Yeah. Except for explicitly do not interact with illegal protocols. That's pretty fair.
I think that we can say that, yes.
So like to use Tornado Cash as an example, because
Yes.
it's the most prominent one that people can look up and kind of know what's going on. The question is, has it been censored? Well, yes and no. The code still exists, and you could still theoretically engage with it, but front-end providers are not allowing access to it anymore, and because of the fear of what could happen to them as a result of violating OFAC sanctions. That's a serious crime.
Right.
So the idea that any blockchain is going to be fully censorship resistant, I'm skeptical of.
Yeah.
Because there's always you can always make it punishable to engage with something in a certain way. So like free speech is free in the United States, unless you lie to a judge.
Well, I'll take that back though, because the thing here is that Bitcoin, nobody rules over that, and it is censorship resistant.
Yeah, but
Because the government can say, well, we're not going to be using this anymore, but there's nobody behind it, and it just works on its own.
it doesn't matter. The government can absolutely make it a crime to interact with Bitcoin.
Yeah.
Absolutely.
Yeah.
They can make it punishable.
You don't have to censor anything. You just make it illegal to do it.
Yeah.
I mean, I understand that we're saying censoring in that sense, but you're not getting rid of the code. You're not hiding the code even. I mean, you talked about front end. They're not allowing access to it, but if you are knowledgeable enough, savvy enough, you can still access it if you go in through different ways. So the code still exists. They're never going to get rid of it. But yes, making things illegal has the similar effect.
Yeah, and that's not to say that it will end Bitcoin or end the blockchain or whatever, but it will push it underground. And it's a fact of social science that if you make something harder for people to do or more punishable for people to do, fewer people will do it.
But that's true.
Or
that is
it
true.
will become a space where
Right.
outside activities happening that can't happen in the regular economy. I mean, black market.
And there's got to be a
nefarious and all
proper
kinds of
incentive for
things.
people to do that, and there are incentives for people to engage with
Yeah.
codes illegally in this way.
Yeah.
North Koreans do it, Russian gangsters do it, all kinds
Yeah,
of
like we talked about the last time about, crimes. All right, the other thing I want to mention about this is that by doing all of this, it's much, much cheaper though. To DeFi, if you're going to send something, if I want to send you money or to another country or whatever it is, right? Let's say that I want to send some money to my parents in Chile or something like that, and you're working here. You can actually use your wallet and you send it, and you're talking fractions. And not only that, the thing is that I can send you $100, I can send you $5, or I can send you 10 million bucks. And it's still going to be fractions. We talk about if you send $10 million on Cardano, for instance, you might talk $10 for sending it. Banking system, you got so many middle hands, and everybody wants to get paid. And I remember sending some money to my son, which is abroad, and we did it two-way. One way was that I sent him some crypto money. And that on the $100, I think we spent 57 cents. And then then another family member, went the traditional way with the bank and sent it. And by the time he actually got the money, he got $78, right? So that was, $22 something lost by sending it the traditional way, comparing to the crypto way, which 50 cents or $22 on a $100 transaction. That's a big difference.
Yeah, and I think, it seems pretty established at this point. Remittances are, for example, an excellent use case of cryptocurrency. They allow free flow of money across borders pretty easily. Even in governments that are suspicious of crypto, Russia, for instance, has a very hardline anti-crypto stance in terms of people owning and buying goods and services with it. But they're totally cool with using crypto to settle international payments now.
Yeah.
As of like 2 weeks ago.
Yeah.
Wow.
I
Turns
did
out.
read that. Too.
Yeah. So there are absolutely some expenses that can be eliminated by doing it this way.
Banks have been using this for a long time.
Yeah.
I do know, for instance, there have been banks that you go to the banks with $100, you give them $100, then they take that money and they say, oh, we're going to send it to France. They send it to a French bank using cryptocurrencies to send it over to the Bank of France, and then whomever comes on the other end and withdraws that money. On both these two ends, I'm paying here and he's paying here, but the bank, the transaction was hardly nothing.
Yeah.
So we do know that they make a ton of money. I mean, there's no, just think about it. Just walk around in your society or you see it back home and see how many new banks there are popping up all the time.
Yeah.
Where does that money come from? Ask yourself that.
Well, I think the key thing to keep in mind here is that when the banks are acting in this capacity, they're acting as a service provider. What you're getting in exchange for spending that extra fee is the ability to not worry about screwing up your transaction on a MetaMask.
The security.
Yeah. It's to not have to worry about your $10 million getting
sent to
the wrong person and then having to beg to give it back. So, and I think as long as that is a service that middlemen are willing to provide, people are going to be willing to pay for it. Now, that's not to say that there aren't advantages to doing it the DeFi way, because if you're savvy enough and you're confident enough, you know what you're doing, sure, but you have to be savvy enough and confident enough and know what you're doing, and especially if you're handling other people's money, then you got to be really careful.
That's true. That is true.
That's true.
So,
okay, so I know we're running a little bit out of time. Let's talk about the Ethereum Merge.
all right.
So today is today, September
Yes.
15th. Ethereum is moving from proof of work to proof of stake.
Yes.
Let's just start there.
Okay.
What is the difference between proof of work and proof of stake?
As quickly as I can put it, a proof of work blockchain validates its blocks, meaning it authorizes the transactions as valid by having computers all over the world compete to solve intense mathematical puzzles. And then the one that successfully solves the puzzle is allowed to validate the block, and it's rewarded with a coin reward. That is how Bitcoin works. That is how Ethereum worked until yesterday.
And proof of work, actually, for you that don't know this, is that they've always been talking about, using a lot of electricity.
Yes.
And that is the proof of work, is that you're using computers that are running these algorithms and solving these problems and all that kind of stuff. And that
Yeah.
you need a lot of electricity to do that.
In fact, that is the idea behind a proof of work chain, because in order to garner up all the necessary energy to go back and change a transaction on the blockchain, you could theoretically do it, but it would take more power than like 1,000 suns or something absurd
Right,
like that.
right.
So that's a security feature.
Yeah.
But its drawbacks are it's slow, it's inefficient, it has limited throughput, and so on.
Yeah.
Proof
And
of
it takes up an enormous amount of
and
energy.
it takes up an enormous amount of
Yes.
energy. Yeah. Proof of stake is a different model in which the blocks are validated by validator nodes that earn the right to validate by staking a certain amount of their tokens in the network. And what that means is they basically post a deposit of, at this point, it's 32 ETH is the minimum, and ETH is $1,500 today, so do the math. 32 ETH posted to the validator node. Now, the nodes have to agree, essentially, that the transactions in the block are valid, and if any nodes try to rewrite or falsify the information, they're penalized by losing their stake.
Losing money.
Yeah, losing money.
Yeah.
So the incentive is don't lie to the blockchain. First of all, everybody will be able to see that you're the one that's lying.
Yeah,
and two, we'll punish you for
and
it.
And actually, that's an algorithm that checks the validation of the
Oh,
block.
right.
Yeah. So basically, it is like this. If I have a lot of money, I can buy a lot of tokens or Ethereums, and then I put that out there and I become a validator. And as a validator, I will then check on all the transactions coming in and basically doing the work that the proof of work would do. But we're checking so everything is okay. If I'm the first one that got this right, then I send it out to the rest of the chain or the other validators. They look at it and they say, yes, this looks right. The code looks at it and they said, yes, you won that block and now you win the Ethereums that was attached to for you doing that work. So basically the work itself of doing the algorithms and validation and then the payment is the same.
All the same, yeah.
But instead of having a machine sitting and doing all of this for you and using all of that electricity, then the validators will do that. And then of course, the more validators that are out there, the better it is, right? And as you said, 32 it doesn't sound like much, but you add that
Yeah.
up, and so $1,500 times 32. This, so, but you can also do a pool.
Yes.
So the three of us, we might have 32
we
Ethereums
can become a
together, right?
validator
So
together.
then our pool that we name Blockchain of the Future pool. So that pool would then go up because we went in as with our Ethereums to do things like this. So yeah, of course, less energy is a good thing. And then also, how about coins? Because the thing is that when you did proof of work in the old days, there was constantly new coins coming in, and there was kind of no end to it. But now with proof of stake, there's a portion of that also gets burned.
That's right.
So the supply and demand. If you have a lot of things or a lot of Ethereum coming out, then they lose value. But now we're actually going to keep track of it.
Oh, okay. Keep going.
So-
This is fascinating.
So basically, how do I say this? I'm trying to remember what portion. I think it's the gas fees that get burned now.
Yes,
Yeah.
it's portions of the gas fees.
Portions of the gas fees,
So
yeah.
the thing here is that when we win a block, we get those coins, right? And a portion of those coins that you and I don't go in and say, hey, we are validators, so here's a lot of transactions, and I'm going to say that, I'm going to just pick those transactions and put them in there, and then, and if you pay me more, then, I can put you in this block much faster, and so on and so forth.
Yeah.
And I don't know the word for that, but to stop that happening, what they do is they actually, out of that, they burn some of the tokens. So that keeps the value of it down. It's a little bit more complicated than that, and you can probably look it up online to check that out. But yeah, that's basically how that
Yeah,
works.
the key takeaway here is that for Ethereum anyway, it's designed after the merge is complete, which it is complete now, that the burn rate will exceed the new issuance rate. So that over
Yes.
time, ETH will ideally, in theory, become deflationary.
It's
Yes.
supposed to be kind of a market correction tool, or like to keep it
Yeah,
from
actually,
getting.
It's supposed to drive
yes,
value over time,
Yeah,
for
exactly.
sure.
Yeah,
Yeah.
I like that. That's good.
Yeah.
Well, I made it up, so there you go.
I mean, well, it's something that everybody can tell. And,
Yeah.
so like the merge is important. I know we're running out of time, but like the main thing I think that's important about it is that it demonstrates that Ethereum, being the world's like prominent blockchain at this point, is not a dinosaur. It can adapt. Like the merge has been planned since 2014, like from the beginning.
Oh, wow.
It's been planned for so long that it's been a running joke, and
Yeah,
that
yeah,
it was
I know.
never going to happen. And now,
But okay, well, since you're on that, so
Yeah.
why is it that it hasn't happened earlier? What are the reasons to why it didn't happen?
my understanding is that the developers just needed the time to get it right. It went through several test nets. It went through, I think, 3 test merges just this year alone.
Yep, that's
And there have been multiple, technological setbacks. There was never a hard deadline. This is definitely when we're going to get it done.
Right.
It was always, and the Ethereum Foundation, it's a loose conglomerate of people around the world. It's not like a company that
Yeah, and
directs
don't,
people to get
don't
things
forget
done.
the miners,
Yeah.
because the miners are losing a lot of money on this. I mean, if I roughly, there was about 1 million miners out there mining Ethereum alone, and we're literally taking their income away.
Yeah.
They invested a lot of money in getting all of these machineries and and maybe a storage place and AC. They invested a lot of money to get this rolling.
Yeah.
And then suddenly we was like, no, we're not going to do proof of work anymore. And thank you, and of course, so they were against this a lot.
Well, wouldn't I don't know this at all, but I would think that those miners who've been doing this and invested in it might be the people who are most likely to become the validators. No?
No, because so mining is a fundamentally different process. It requires specific hardware to solve
Okay.
complex problems. And once those complex problems aren't at the heart of validating the blockchain, they're effectively useless.
It's just-
In theory, you could repurpose them for another blockchain, I've heard,
Wow.
but I don't know. 2 points about that. One, they have been saying since the very beginning that Ethereum was going to switch to proof of stake one day.
Yep.
So you knew that.
Yep.
2, I don't pity the asbestos industry or any other that gets shut down
no.
over time. We're not
Yeah,
going to do
no,
this
no.
anymore. That doesn't mean, we're taking away your way of making extra money off the internet. I'm sorry. You were smart enough to figure it out in 2014. Figure it out again. You can do it.
Yeah, I do believe that.
Yeah.
For sure.
Talking about that, one of the things is that, they have already started being groups. So I looked at the distribution of Ethereum right now. So 69% of the owners of Ethereum right now is owned by 11 validators.
Yeah.
Right? And that can become a problem, because if you own a lot of these, you go in and you create pools, tons and tons and tons and tons of pools, then you are very likely to win. But you can also start controlling it.
Yeah.
Because you can then go out and say, hey, if you start using ours, then we will give you a lower payment. Because, it's a little deeper than that. And I'm not going to go into details because, like you said, we're running out a little bit of time. The other thing also is that the censorship on this. If you have, we have one, the lead of finance, for instance, is one of the big ones out of the 11 validators. Mm-hmm. If the government goes in and say, hey, leader, we don't want you to do this anymore, or we want you to do this, mm-hmm. then you don't have that censorship that you would have had on proof of work.
Sure.
So in my world, or my way of thinking is that, yes, proof of work requires a lot of energy, but it's much safer as far as governments and pool stakers being few and all that kind of stuff. But proof of work has its good things too, right?
Mm-hmm. Yeah, proof of work is, I think, generally considered the more secure way of doing things. But it just comes with the natural limitations, like the speed, the throughput. It just doesn't scale, at least now. With something like Ethereum, concentrating all of these all this in these pools and stuff, I think the way the government is going to approach this, I think, and again, I can't see the future, is that, and I'm not the only one saying this as well, by switching to a proof of stake consensus mechanism, the question becomes, does Ethereum become a security? Because now you have large pools of capital that are deriving profits based on the percentage of their holdings in this network. And that looks an awful lot like something familiar. Mm-hmm. Up to this point, the Securities and Exchange Commission has refused to say one way or another if Ethereum or Bitcoin are secure. They tend to allow Bitcoin on the commodities edge of things, but Ethereum they won't say. And I think that's in part has to do with this development that was on the horizon. So watch this space.
Yeah, I also wonder a little bit, because you get all of these other groups that have attached themselves and building on the old Ethereum, Solana, or is Solana one of them? Or anyway, it doesn't matter. You got thousands of other entities that are built around the Ethereum on the network. Are they easily just going to be moving over, or is there going to be a problem with that? We don't know that yet, do we?
No, I mean, right now Ethereum has been the main market draw in the blockchain space, in part because of its accessibility. It's designed to bring everybody on board, and it's nominally decentralized.
Yeah.
And that's,
two things really quickly. A crypto briefing, are you going to write something about this and add that to that? Because if you do, then people, go there. Crypto briefing.
We've already written about it.
Oh, you have? Oh,
yeah,
okay.
I mean, it happened last night at like 1:45 a.m. CryptoBriefing.com. Check it out.
All
We've
right.
got all the
There
coverage.
Yeah. The other thing I want to just really, really quickly talk about is that because Cardano is coming out with self-forking, and that's super big too. And in the world of blockchains and everything, I want to say that Cardano and Ethereum is the two giants. I think.
They are two sides of the same. I don't know if you talked about the history of Vitalik and Charles Hoskinson.
No, that's a different episode.
Cardano and Ethereum have a lot of the same people involved.
Yes.
And they went separate ways. And
Gotcha.
Yeah, the founder of Cardano, Charles Hoskinson, he actually was one of the founders of Ethereum.
Yeah.
And we'll leave it with that one. Since we are leaving it with that one, thank you so much for coming. And I know we can continue this forever.
Yes.
But we will see you next time. Thank you.